Tonight's non-farm heroes NFP. What is the real story here? It's not about whether the data beats expectations. It's about whether the officials will cook the books again. You probably still remember the previous NFP prints this year were so observed that the moment they dropped, quant funds collectively triggered massive sell-offs. Take February, for instance, the officials first dropped a massive market beating number. The immediate result, gold was instantly slammed down by $30. Then, behind the scenes, they quietly revised the data downward by over 400,000 drops. Come March, they pulled the exact same stunt. That's why tonight my eyes are actually on the wage growth data because that is what indicates because that is what dictates whether a secondary inflation wave will kick off. The market's ultimate fear right now is the full-blown wage price spiral, which would heavily reinforce expectations for the Fed to keep it tied to monetary policy. And back to today's charts. Gold is still built like a deck of cards. The rebound highs are constantly shifting lower and volatility is compressing. A classic setup for a major breakout. And personally, I will leaning south because aside from the AFP, the warning signs of a correction in US equities are already emerging. Think back to March. Every time US stocks suffer a sharp correction, gold plunged right alongside them. And while gold carries safe haven attributes during times of extreme market turbulence, mega hedge funds seeking immediate liquidity will instinctively liquidate their most liquid and cash convertible asset first, gold. This is what drives the simultaneously crash of both stocks and metal. The difference this time, however, lies here. The speculative bubble in the gold market has already been largely cleared out. Even if tonight's wage data explodes or a stock market pullback triggers a sharp drop in gold, it will absolutely not morph into the kind of chaotic, cascading long squeeze we saw previously. And therefore, if gold does sell from here, the downturn will be remarkably short-lived, and a P-dug by that drop will fill by a rebound and recovery far faster than most people anticipate. And finally, to answer a question from my last video, someone asked if central banks are buying gold, why does the price keep falling? Let me pull back the curtain on this. The total accumulated buying from global central banks amounts to just over $90 billion for the entire year. Yet, if you look at the global gold spot and derivative market, the daily trading volume routinely surges past $360 billion. Central banks' full-year purchasing power doesn't even match a third of the market's single-day volume. And naturally, they cannot dictate short-term candlestick movement. Specific execution strategy. First, I personally choose to open positions only 15 minutes after the data release, partly to avoid sudden stop hunting spikes, and partly to wait for the true direction to emerge before acting. And second, I still lean toward a sell-on rally strategy. If the market pumps, I will continue to lay out short orders near the 4,500 resistance level. If it plunged directly, I will ride the momentum and short it. The views above are solely my personal trend analysis and do not constitute investment advice. Special thanks to EBC Financial Group for sponsoring this content.